think the key piece for me about accounting is it just makes sense, right? Everything has a home and a bucket, and you need to measure things in order to be able to improve them. So fundamentally, that made sense for me. So I think early on, probably unique and as compared to most small businesses, where I felt like accounting for things properly was important in order for for my company to grow and know what what to improve. But it was probably about 5 or 6 years into running my integration company when I recognized that I was actually looking at too many different categories of things. And this is frequent, this is something we frequently come across with managerial accounting is there's almost this desire to track things at such a granular level that you lose focus of the big picture.
Welcome to the Flywheel Effect, the podcast where ambition meets expertise in the world of luxury home services. Whether you're an entrepreneur, a small business owner, or a forward-thinking professional, this is your platform for growth, profit, and prosperity. Each episode, we dive deep into how to leverage data for smarter business decisions and share insights that help you transition from technician to visionary. Let's jump in.
Hi, and welcome to another episode of the Flywheel Effect. I'm here, Brent Sonnek-Schmelz, with my business partner and co-host, Matt Bernath. Matt, how's it going today?
Doing amazing. It's Friday. Looking forward to an incredible weekend. And I just had a nice walk with the dog for about an hour and a half this morning. It was nice.
That sounds great. I think I have family out in California, and I've been bragging about my New Jersey weather, which sounds like it's better than the 65-degree California weather that's happening right now.
Yeah, it's been cool, but we're now into the mid 70s and the low 80s, or at least for the next week. So I'm pretty excited about it. That's gorgeous as far as I'm concerned.
I think that's great. But it's been the same here in New Jersey, which is always
Nice.
fun. It's a nice little change of pace. All right. So today we are going to get into something that I like to call a BBI topic: boring but important. Managerial versus financial accounting. 2 ways to look at your books, 2 ways to consider your numbers, 2 very different ways to figure out what your P&L and balance sheet look like. So before we get started, just so everyone's on the same page, Matt, can you do a quick definition of what financial and managerial accounting actually means?
Yeah, I mean, they're similar. So financial accounting primarily focuses on, accounting for the financial aspects of the company from the broader perspective. And the way I think of it is more compliance based and ultimately for, taxation purposes, right? But of course, it's looking at the assets and the liabilities and the income and the expenses, primarily focused on producing financial statements on a regular basis. And managerial accounting is really focused on creating metrics and data in order to drive management decisions in the organization. And so they can be related, but in some cases different. And I've got a lot of experience with both. Primarily what my experience has been with Vital is managerial accounting.
So I want to add a little bit there. One thing, having taught managerial accounting at the university level as an adjunct, found it interesting dealing with accounting students, right? They are fully versed in financial accounting, managerial accounting a little less so. So it took a little explaining. I think the key understanding of between the two is financial accounting is primarily designed for an external audience. So the government, people who read financial statements, investors. Managerial accounting is for an internal audience. It's for how the people that are running the business, how they can make decisions using data. And that leads to 2 really key differences in how they're constructed. Financial accounting needs rules. You've all heard of GAAP. Generally, I even forget what GAAP is often.
Generally accepted accounting practices. Yep.
There you go. Terrible professor, right? Generally accepted accounting principles that follow rules so that financial statements between companies and among companies are comparable. You can know what revenue is, gross profit, what profit, what assets, liabilities, etc. Managerial accounting has essentially no rules other than accuracy and usability, right? How do you take the data that you did, production, sales, expenses, etc., and how do you apply it to your processes at hand so that you can make decisions? So Matt, I mean, let's dive in. What do you, as a business owner, right? When you ran your integration and security businesses, when did you really learn how to apply managerial accounting as opposed to thinking things through financially?
It's a good question. Before I tackle that, though, I want to add to what you just said about
Sure.
financial accounting. Is designed to create this apples to apples comparison out there in the world, right? And that's what GAAP, I think, was designed for as well. And it's funny because I don't think I've ever seen an application of GAAP or financial accounting that actually allows an apples to apples comparison. I mean, that's why you have firms get involved in M&A transactions to normalize all that stuff, right? You have there's so much effort put into looking at the books and normalizing transactions, even with big, well-established companies. So I think that's kind of an ironic piece there is even though financial accounting exists and GAAP exists to try to normalize those things, rarely do we ever see that truly applied.
Oh, for sure. I mean, I had a quick add on to that for a second. What's really funny is oftentimes, especially in private companies, the normalization is because it's garbage in, garbage out. So you actually got to figure out what dinner was as opposed to just looking in the trash, which is what most numbers end up actually being.
Yeah. Yep. But yeah, to your question about, at what point did I recognize, I think you asked what point did I recognize the value of management accounting, right? I think that's really the essence of the question. Yeah. So, early on, I've understood accounting since I, went to business school. And I think the key piece for me about accounting is it just makes sense, right? Everything has a home and a bucket, and you need to measure things in order to be able to improve them. So fundamentally, that made sense for me. So I think early on, probably unique as compared to most small businesses, where I felt like accounting for things properly was important in order for my company to grow and know what to improve. But it was probably about 5 or 6 years into running my integration company when I recognized that I was actually looking at too many different categories of things. And this is frequent. This is something we frequently come across with managerial accounting is there's almost this desire to track things at such a granular level that you lose focus of the big picture. And that's what I recognized when I went out and got some help with my business is, my coach at the time said, look, it's great that you're tracking all these categories and all these transactions, but at some point it gets so small, these transactions and categories are so small, they're not meaningful. But also, unless you're actually analyzing the data and making decisions around that data, it's not worth collecting that data. The other piece that I recognized that I learned pretty early on was that the more categories of transactions you try to track, the harder it is to maintain accuracy in those metrics, because your staff who's responsible for those transactions, they may not be able to choose the right category because they're just not anointed with that knowledge, right? There's just too many things to choose from. So it ends up being garbage in, garbage out, which we see all the time. I mean, I've seen P&Ls that are 300-400 lines long. And when I ask a business owner, like, hey, what do you do with all this information? Inevitably, the answer 100% of the time is nothing. The more complex the P&L, the less frequent they're looking at it, frankly. And so, I know you didn't ask about this directly, but that's one of the things I learned early on was start with simple, and then you can always make things more complex. But if you start with complex, it's harder to make them simple.
Now, it sounds like you said you got some interesting insights from your business coach. Did you get similar or helpful insights from your CPA in how to look at things?
No. Nope.
Yeah, what did this kind of advice did the CPA give around that you found?
Well,
I
zero.
would no reason to call it CPAs a little bit, but we could do a little. Don't.
Yeah. Zero advice on the managerial accounting side. It was all compliance based. And, there was no talk of how to categorize P&L. Frankly, in hindsight, as I got into, Vital and a little bit more into the world of working with accountants at multiple levels, multiple different businesses, just frankly surprised at how few questions there were about what they were seeing. They took everything at face value and just did what they did. So yeah, no direction really from them on how to align things on that side.
Yeah, and in that question there's a little bit of facetiousness on my part, but which I tend to try to do occasionally. But when it comes to CPAs, the ones that I've spoken to, They're really are concerned about compliance and whether you follow the rules, as opposed to how you use those numbers to run your business, right? Like I think within the vital world, gross profit and how we calculate it is a prime example. I think we hear from prospective clients all the time that they calculate gross profit differently and they don't understand how we do. I mean, it'd be good. This is a great example that I think you give a little light on of why we have to think of them differently.
Yeah, I mean, there's a few reasons. One of the primary goals for Vital in what we do is being able to benchmark and compare business to business. And that in and of itself requires standards beyond just gross margin. But gross margin becomes a really important topic because it's the number one metric to manage in the business for profitability. Time and time again, doesn't matter what industry you're in, profitability starts with gross margin. Now, it happens to be that because one of Vital's key ingredients is tracking gross margin, we have to track it the same from member to member. Therefore, we can't have a member who decides to throw labor and vehicle fuel and all these other things into their COGS calculations where another member does not. And that's one component of why we look at gross margin the way that we do. The other piece, and I'll step back a little bit. In the Vital method, we look at gross margin, what we call top line margin. And that's revenue minus the cost of the equipment and parts. So we actually do not include labor costs in our cost of goods and gross margin calculation. We do that for a number of reasons. One of them I already said, from a normalization perspective, it just makes it easier to normalize from company to company. But also, the labor costs in these businesses tend to be more fixed than variable. And that's because if these technicians don't have projects to work on, they're usually doing other things. They're training, they're running service, they're building racks at the office. There's all kinds of stuff for them to do. So generally, we see that as more of a fixed expense, and it doesn't always trend with revenue. And the reason that's important is because profitability of these companies can be tied directly back to that unproductive time, just as it can be tied to the productive or billable time. So it's important to see that separately. The other thing is that when we blend all of these things into that gross margin calculation, that gross margin can vary quite a bit for the reasons I just said, the labor piece, but also it makes it harder for us to see the gross margin on the equipment and parts, primarily because it's just blended all together, right? When we look at top line gross margin, that's a better reflection of the proposal side of the business, which is again where all the profitability starts. We have to have profitable proposals to begin with. And labor happens to be a wild ass guess on most of these proposals anyway. So if we try to blend that in, gross margin on labor is a guess when you're doing a proposal. So those are, there's 4 or 5 reasons that we do it that way. And those are the main reasons we do. But when we get pushback from a CPA, the main question we ask them is, hey, Mr. CPA, how often do you actually look at the P&L and care about when, where the labor is? And the answer typically is, well, once a year when we do taxes. We say, okay, cool. Then that would be easy enough for you to just move the compensation where you want it if you want it up there for your taxes, right? If you want to move things around once a year, that's totally fine. That's easy to do. But from a managerial perspective, we need to look at these numbers every single month. And that's why we arrange things the way we do.
Yeah. And I think what you just point out is this is not an either or situation, right? This is, You need both. You need your financial accounting for taxes, for your annual statements, and you need managerial accounting to make decisions day to day. And it's really, and CPAs think about what they need it for. And business owners take that as gospel very often, have a better perspective of use both. Like when I was back in private equity, when we would do site visits of a new company, within the first 10 minutes of the meeting, we'd use pleasantries, talk about their business a little bit. We ask a very simple question to everybody. What are the 3 metrics you look at on a daily and weekly basis to get a sense of how your company is operating? And depending on what they said, we would know a few things. One, are they actually thinking deeply about the metrics that matter? Because I think metrics change company to company. It could be the throughput for the day or week. It could be lost labor time. It could be their There are projects that are in the pipeline. Could be a number of things, but almost never, other than maybe revenue and units, are a traditional financial accounting metric. But we find out whether they are thinking deeply about their company. We also get a better idea of how to consider their company when we are looking at it as far as whether it is successful or not. Because those metrics really, really drive the decision-making process for all parties involved when it comes down to successful growth, profitability, and also knowing when things are going bad. I mean, metrics tell you metrics can be 3 or 4 different items, cut, pasted, divided, multiplied together. They give you a number, and how that number changes over time could be your best indicator. And the business owners that do that on a regular basis with very, very specific and very few metrics tend to be the most successful ones.
Yeah, I agree.
So Matt, now we've spoken glowingly so far about managerial accounting. When do you see it go wrong? Because I think it's not a perfect science.
No, I mean, in our experience, and really my experience in Vital and then also in some other businesses, is when there's too much complexity. There's a fine line between producing the right metrics in a usable way versus spending too much time getting metrics that don't matter. And, I think one of those scenarios that we've seen kind of time and time again throughout luxury home services and construction industry is an overemphasis on job costing. And while job costing can be really beneficial, an overemphasis on it, it's almost like you're looking at the pebbles, but yet you're stumbling over mountains. And part of the issue with job costing, specifically for luxury home service providers, is it does not take into account the non-productive time. So for example, if you've bid 80 hours to do a project and your team goes out there, you get 2 guys out there for 4 hours of productive work a day. That's 8 hours of productive work per day, but you've paid 16 hours, for example, right? And maybe there's even overtime. But so it takes you 10 days, 2 guys, 4 hours a day, billable time. That's 80 hours. That's a win. You did that project at the exact amount of time that you proposed. However, you have all this unproductive time that's not accounted for. And the reality in many home service businesses, custom integration specifically, there's a lot of unproductive time that's unaccounted for. And that's often where we see the biggest improvements in these businesses, really any service business, is identifying not just what's happening when you're in the billable work and you're on the job, but what's happening off the job. How long is it taking to get out of the office every single day? How much windshield time are they spending? Are your technicians and service people responsible for servicing the vehicles and gassing them up and things like that? It can be really expensive when you have a team of 2 people at $30 an hour doing some of these things. Not to mention the opportunity cost of not being able to bill that time. And even worse, there's so much overtime happening out there. Sometimes we're paying overtime for these folks to fill up the vehicles or buy their burritos in the morning or whatever the case may be, right?
So you spend a half an hour, you just lost $50.
Yeah, and they're chatting and doing their thing, and so I think job costing's great. The other issue, job costing's great, but there can be an overemphasis on it. And what we've seen time and time and time again, because we meet with over 100 companies a year to review their financials, the ones that have spent a ton of time and effort job costing are not producing any marked improvements over those who aren't. And so when you look at that, like, okay, you're doing all this, you're performing all this admin work to job cost the heck out of your business, which feels good, but it's not producing any better result than the guys who aren't job costing. And again, we're not saying no to job costing. We're saying there needs to be a line drawn in the quality and the quantity of your job costing efforts. So I think that's one of the biggest ones that we see on a fairly regular basis that just doesn't pay off.
Yeah, it seems like it's missing the management side of managerial accounting. It's using a metric blindly.
Yeah.
Which is a big problem.
Yeah. And related to that is just overcomplexity. I mean, again, to go back to the 300 line P&Ls, we come across these fairly regularly. And when we ask anybody in the business, why are we doing things a certain way? It's that same response that you hear over and over again. It's like, well, this last person taught me, so that's why I'm doing it, right? Nobody's ever really questioned, hey, why do we have so many different income categories? Why do we have so many different expense categories? And frankly, when we ask them, what do you do with these different categories? They don't really have an answer. The person who's putting the transactions in just doesn't know where to put them. So they end up in all these different random places. So I think that's where managerial accounting, the intentions can be really good. The intention of job costing, very solid intention. The intention of having a bunch of different categories of tracking, very solid intention. If you have a way to ensure the quality of the transaction, the quality of the decisions around the transactions, and then if you can ensure that you're actually using that data.
Yeah, it's interesting. So part of building off of that, it reminds me of an experience that I had with standard costing. Now, standard costing is when you have a complex P&L, you take those numbers and you translate them into standard. So where you're making an assumption of what overhead is, what a certain part is, what electricity usage, whatever. And in business school in the summer, I had to do a job. My summer internship was a Crown Cork and Seal, producing an actual costing model for production of soda cans, as opposed to a standard costing model, which is what they use. And the problem with standard costing model is that every single job, if they use a standard cost, depending on the factors all changed, was either overpriced and they didn't get the job, or underpriced and they got the job and they lost money. Right. So they could never figure out and it was a terrible situation. So I was trying to go in there to help them sort that stuff out. For those that don't know, Crown Cork and Seal is a 150-year-old bottle cap manufacturer, essentially, and packaging manufacturer, who invented the bottle cap. And Crown Cork is a bottle cap. When you take a bottle cap, like off a bottle of beer, turn it upside down, it looks like a crown. That little rubber gasket used to be a cork. That's how the name Crown Cork. And their logo is the upside down bottle cap, looks like a crown. So kind of interesting history. Side note for me, I have an anecdote that every time I bring up Crown Cork and Seal, I got to say this anecdote, and it's fantastic. They manufacture basically like 80% of the bottle caps in the world, locally most of the time. And sometimes locally means they're made lousy. They're really, really poor quality. Mexican bottle caps in the 70s were notoriously bad, right? All the bottle caps, what would happen is you pick up a bottle cap and there'd be this ring of rust from the steel bottle cap left on the bottle. It's gross. Nobody wants to drink that. So in the 70s, bartenders at Mexican resorts with American clientele would have this ring, and you're trying to figure out what to do because they don't want to rub it with a rag because then it looks disgusting. So what the bartenders figured out they can do is they could take a piece of lime, rub it around the edge of the bottle, and then shove it in the bottle. And the American gringo tourists thought that was awesome. And what did you get? You get the greatest marketing gimmick of all time for beer of the lime in the Corona. It is not because it tastes better. It's because of rusty bottle caps. and even though it had nothing to do with managerial accounting, I just think it's so fantastic that I
yeah.
So, but yeah, and this is the example. Their standard, going back, circling it back around, their standard costing model cost them money, cost them projects because it was rigid. And they needed to break the rigidity. How do you deal with overhead? You're talking about how do you deal with downtime? Overhead's a similar thing. Do you apply it? Do you know what it is? Do you think about it differently? How do you manage it as in its own scenario? Because I think overhead's essentially, in some ways, sometimes the entire SG&A. Otherwise, you can calculate it as a few key items. But overhead causes significant problems when you're thinking about your business.
Yeah, I agree. And your comment there brings up an observation that I've seen in all the home services industries that I've worked in, but this idea of costing into your actual hour cost, right? So breaking up the cost of your vehicles, the cost of your insurance, the vacation time, all of that stuff, figuring all of that in and doing what's called a burdened hourly rate. And again, I think in the absence of anything else, this is better than nothing. The downside to coming up with that burdened hourly rate in our experience is that it's always a backward looking number. And in the reality, when we're in a project-based industry like we're in, we're bidding projects today that won't turn into revenue for somewhere down the road. we have to actually estimate what our future costs are going to be instead of looking so much at our prior costs. And so that whole burden rate thing can be a bit of a distortion, not to mention a lot of work to try and keep up. So we happen to have a process of looking at things, we have a forward-looking process where we can estimate costs moving forward and set goals based on that. We believe that's a better process for any service industries to think about what are your costs going to look like when it's actually time to produce that work? What are you going to be paying for the materials? And primarily, what are you going to be paying for the labor? Because in just about every service industry that we've worked in, the labor is the factor where many of these businesses are missing their bottom line profit.
Yeah, that's actually really important. And that's so hard to do as a business owner, right? To try to forecast cost and how you build that into your bids on a project basis, right? Like if you're ongoing business that's regular revenue, every day you make a sale, then it grows, it's one thing. But projects, totally different. And I think a lot of business owners get really bad advice about exactly that. And it causes them serious headaches. If everything works well in a growing market, right? Where everyone's making money, everyone's got the next job's profitable. Where this all comes to bear is when next quarter is not as good as this quarter. And all of a sudden your fixed costs account for a much larger percentage of your revenue. And then that burden is all screwed up.
Absolutely. Absolutely. And that's the other reason looking at COGS and the way that people traditionally look at them, trying to take the manufacturing perspective and applying it to the service world just doesn't.
Right. That's absolutely. So it's looping back around. We've been talking a lot of managerial accounting. Let's give the kudos of where due is the importance of financial accounting and what are the kind of key things you have to do in your business to make sure that remains kosher, right? I think that's a really important thing. When it's having a good accounting advice, but keeping your books in order, right? I think that's a big thing. With that, I think is a lot of the other problems is when people are hiding within your financial accounting, hiding things that maybe shouldn't be there.
Yeah. So what are some examples that you've seen there, Brent?
One is personal expenses, obviously. That's the biggest one. Do you have people on payroll who shouldn't be? Are you funneling vacations through the business that shouldn't be, that somehow potentially get you in trouble? Is your convertible now a business car? Those are some of the ones that are problematic, can get you in trouble. But I think even more generally, it's what happens to cash. And I think cash ends up being a big issue if not managed correctly.
Yeah. I think you bring up some good points. So, when we've worked with small business owners, and some of these, when I say small business, some of these are fairly large small businesses that are still doing the things that you're talking about, right? These can be 8-figure plus businesses that are still, fun, running them as lifestyle businesses. So what are some of the things, when these small business owners hear you say something like that, like, hey, maybe these people who are on payroll shouldn't be on payroll, or maybe your convertible shouldn't be a company vehicle. When they hear that, they dismiss it, right? Because they're like, hey, well, that's how I'm saving money on taxes every year, by reducing my bottom line. What are some of the specifics that you would suggest to those folks to help them understand why what they're doing actually isn't as beneficial as they think it is?
Few reasons. One, it makes it harder to get outside financing, right? I think if you are ever think that you're going to have to go to a bank for a line of credit, and you cannot show profitability on your tax statements, because they're going to see your tax statements, or on your financial statements, you are not going to get that line of credit, or it's going to be significantly less than you want. If you ever anticipate selling your business, everything has to be recast. And actually, the buyer may require you to redeposit those misappropriated funds back in the business. Third, people do get in trouble with the IRS, right? It is possible that the IRS comes to say, why is this person on the payroll? Have they worked a day in their life? Or what's the deal with this car? Every other car in this is a van, and here's a Maserati. Why is that a deductible expense? And you got to explain it, and it becomes a problem. So those are Think about those kind of problems is those are tomorrow's problems. They're not today's problems until all of a sudden tomorrow is today. I look at taxes like the beauty of paying taxes is that you made a lot of money, right? Like, let's not beat around that. Let's understand that you only pay taxes when you do well. But those are in my kind of legal M&A mind, those are the three big ones that come up to me. I think the ones that could hurt you the most is that you can't get a line of credit if you need it, because when you need it, you need it. But Matt, what other places do you see as being problems? You are more in the weeds of the day-to-day operations.
Yeah, I think those are great, and we review those on a pretty regular basis. The other one that we see is overall distortion on management metrics. So, again, we meet with hundreds of businesses every year. We look at their financials, and we could be sitting in front of a business person saying, "Hey, you're making 3% net operating profit," but they say, "Oh, well, that's not the full picture. The full picture is, I've got all these people on payroll, and my all of my personal purchases, and I got all these vehicles, and if you look at my balance sheet, half of these vehicles are personal and not company." I said, "Okay, no problem. So then tell me about how much net profit you should be making." And I don't know. So how much distortion is there in your financial, records? Nobody knows.
Yeah.
And so at that point, I could be sitting in front of a very successful business owner who has the opportunity to be 30, 40, 50% more profitable, but they don't know what levers to push because there's so much distortion in their numbers. Now there's a place to get both, right? There's a point where it's too much, where the lifestyle business thing does need to be pulled back. But we have plenty of business owners that we work with who still run a lifestyle business because they never intend to sell. They don't feel like they're ever going to need outside money. But we've set their business up in a way where there's no distortion, right? Where they can see the levers clearly and they know exactly what's being spent on the lifestyle piece versus not. So if they did have to recast, it would certainly be a lot easier to recast. Now, that doesn't change the whole IRS thing, which, by the way, I'll tell you a quick story. I've been a passenger on that ride. I had a good friend of mine who was actually running a sports car racing. I don't want to call it a team, but his hobby was sports car racing, and he was operating it under his business, very successful, pretty large business. So it wasn't a huge line item for him, but he was spending probably about $250,000 a year roughly on this racing program. And he'd been doing it for a number of years. And he did end up getting audited, and the IRS did not let him get away with it. And he'd been doing it for about 4 or 5 years. And it was a very large tax bill. Some of it they let him, put in his marketing expense. So it wasn't this, $1.5 million dollar thing that it could have been, but it was a huge hit. Now, thankfully, he, made some right decisions in his business and his lifestyle where he had the cash, but it was a big check, and he was not a happy camper about it. And of course, it changed his lifestyle moving forward.
Yeah, it's one of those no one thinks it's going to happen to you until it does situations with the IRS.
To maybe 1% of his income. It wasn't a huge number as far as the company P&L, and that's why he thought he could get away with it. It's like, he had it split up in a bunch of different areas, and yeah, it was a painful exercise.
Yeah, they once they have a bone, the IRS is not letting go.
Yeah.
Looping back around, when I think of cost accounting or managerial accounting, one of the key things that I think of, and I'll bring this is another anecdote that I enjoy. It's one of my, I have like 3, and this is now 2 of them in this one episode. When you think of it, one of the things that lets you recognize is where there's inefficiencies in your business. And those inefficiencies can be the difference between just okay performance and massive, phenomenal performance and profitability. Mm-hmm. And sometimes it's just by looking at the metrics, it can be a very, very simple change. Now, my anecdote here is I think a really good one. Is you guys know Dum Dum lollipops, right, Matt?
Yeah.
Right. What's your favorite flavor?
I don't even know. I'm not a huge fan because they're so small. They're like a tease. So Dum Dums are low on my list of favorite candies. Right. I want something with a little more substance. I'm a sweets guy, so I need something. I need like 6 Dum Dums in order just to satisfy my itch.
Well, if you had 6 Dum Dums, so my favorite growing up, my favorite flavor was always the mystery flavor. Remember the mystery flavor? You had like orange and root beer and cherry. Then there was
Yeah.
this mystery flavor that you didn't really know what it was. You couldn't really identify it, but it all, a fifth of them were always this mystery. So I, being
Yeah.
a person that likes different things and not knowing what's going on, I always pick the mystery. And by the way, I think mystery is actually their most popular flavor. How they came across, developed the mystery flavor is actually a managerial accounting problem. It's really actually interesting. So one of the issues with Dum Dum Lollipops is you have a run. You run of a single flavor on the machine, certain number of runs. And the longer you do that run, the more efficient it becomes, right? So whether it's a day, 2 days, a week, whatever it is, one flavor, one this. But there was a problem. When you want to switch to the next flavor, you had to run a certain amount of material through it until such time that the next flavor was coming out clean the other side. So that was lost productivity time, material waste, time waste. It was a mess. So what the Dum Dum management, whatever company it was at the time, looked at this and says, well, how we're losing 10% of our cost or gross profit, whatever the number is, on this transition time period of materials, time, etc. How do we eliminate that? And what they realized is that you run one flavor and you immediately start the next flavor. And while you have a blend, you don't have any pure flavor. But if you're able to also turn that into lollipops, you can sell those. How do we sell them? Do we send blends? Because no, every lollipop is actually a little different. Some has more cherry, another one has more root beer, some range between the two. Let's just call them mystery pops. And so they took all those pops because they recognized that by essentially eliminating downtime of the machine, they can increase their profit by and they can increase their profit and inventory and everything by 10% or whatever it was. All of a sudden, they started making significantly more money by thinking through this problem from a managerial accounting perspective. And that mystery pop is by far their most popular flavor. Kids go for it all the time. If you're looking at Dum Dums, I think they run it on purpose now. But to start with, it was just a way to eliminate waste.
That's awesome. I think that extends beyond just the accounting discussion and into what we experience with the luxury home service providers is they're craftsmen by and large. And they're really good at what they do, which ultimately creates this perfectionism mentality. And I think one of the lessons I took away from your conversation there is, if you had a room full of perfectionists, would they have ever allowed the mystery flavor to exist? No, because it's unpure, right? It's not perfect. But somebody in that room recognized that, hey, we don't need a pure flavor to make money on this thing. And so I think it goes beyond the accounting piece is great. And the lesson there is awesome. I took away another lesson of, hey, the more you are focused on perfection, there's a really good chance you're missing some opportunity outside on the fringe.
Oh yeah. Perfect's the enemy of good enough, for sure. It's really cool. And to me, when I'm teaching managerial accounting, I use that anecdote when I'm talking mostly job costing, right? And I bring in Dum Dum lollipops and I hand them out to the 30 kids and I ask them what flavor they're having and some of the mystery. And some people say they love the mystery, or some people say, oh, I don't want to eat sugar, whatever. And we go into this and it's like, wow, this kind of rings a bell. This stuff we're learning, managerial accounting, how to look at metrics, how to think of your business through data, can lead to transformational decisions such that your business becomes significantly better in a relatively short period of time. So it's not just academic. It's not just boring accounting. It's how your business becomes awesome is what I say. And wow, this title a little bit boring, but important. It's anything but.
Yeah,
boring.
Absolutely. I agree.
Well, Matt, anything else here to add? And let's close this out.
No, it's been fantastic, Brent. Thanks for the anecdotes. Big smile on my face, and I'm sure our listeners as well, as they listen to you tell those stories. You're such a great storyteller. And I think there's a lot of takeaways here from the boring but not important discussion on managerial versus financial accounting.
Boring but important. That knot is, believe it, that knot. Yeah. So thank you everyone out there. And as always, we do not have any advertising advertising on the Flywheel Effect. If you found value in this, if you found entertainment in this, please do us 2 favors. 1, leave us a review, 5 stars if you can. And 2, share our podcast with someone who you think would find it useful. So until next time, this is Brent Sonnek-Schmelz and Matt Bernath from the Flywheel Effect. Thank you, everyone, very much. Bye-bye.
Thank you for tuning in to the Flywheel Effect. Our journey through the intricate world of luxury home services continues to be fueled by your passion for excellence and innovation. If you found value in our conversations today, don't forget to follow us wherever you get your podcasts. More insights and resources, visit us online at growwithvital.com. Until next time.